Hello and welcome to our webinar, 1 year to Brexit, tax implications of VAT and customs. This webinar is part of a series we are giving to help business owners understand how and when Brexit will affect doing business in the UK and beyond. The webinar is a collaboration between Citrin Cooperman and Moore Stevens, our international association, who we work with constantly on many joint projects and clients. I would now like to introduce the speakers. My name again is Paul Daly. I will be the moderator. I'm a tax partner at Citrin Cooperman and I specialize in international taxation. Here are the esteemed panelists that will be discussing the various topics today. The panel of 3 experts are from Moore Stevens London and another Moore Stevens firm, MTH Accountants and Advisors in Amsterdam. All are heavily involved in understanding and consulting with their clients as they navigate Brexit. They are Kevin Phillips, a partner in the Moore Stevens business tax team, specializing over the last dozen years exclusively in international tax. Kevin's work includes the tax-efficient structuring and financing of both overseas operations of UK companies and UK operations of foreign multinationals. Nick Warner. Nick is a VAT specialist with over 25 years of experience with VAT. Nick has a particular focus on the insurance sector and also has a wide experience in the real estate sector, particularly care homes and in hotels and leisure. And Tunis van den Berg, a partner and VAT advisor in the Moore Stevens member firm of MTH Accountants and Advisors in Amsterdam. So here are the objectives of today's webinar. First, for our audience in the States, we will refresh your memory on Brexit. Then we will dig into some Q&A around issues dealing with VAT and customs duties and other corporate tax concerns. Just from a U.S. business perspective, obviously Brexit is really something in terms of uncertainty. The UK has always been viewed by many U.S. businesses as a gateway to Europe in terms of doing business. It's kind of like a stepping stone to be trading with other European Union countries. The big question and the uncertainty for a lot of U.S. businesses, will that still be the same if UK's trade agreements are less enabling or in a state of flux? I'd then like to go into just a little background of Brexit, because we've all been reading about it a lot and it's been around for a while, but now it's really, if you may, coming to fruition. The decision to leave the European Union was made June 23rd, 2016. Last year's referendum was a simple yes or no question for what was arguably the most complex political problem of our generation. Setting aside the oversimplification of the issue, let's consider the impact of the decision and gain an understanding of what we are leaving and what we need to replace. What is the European Union? That's critical, obviously. It is a single market of currently 28 countries, grown from the original members over the past 40 years. It's really based on 4 critical underlying principles: the fundamental freedoms of movement, goods, services, people, and capital. The European Court of Justice, the ECJ, has authority over member states. This provides an overarching authority regarding the laws governing the 4 principles. As a result of being part of the EU, we have customs union, which allows tariff-free goods and services. In other words, goods received into or initiated within an EU country are not subject to additional tariffs when moved from one EU country to another. Passporting of financial services. This includes recognizing the qualifications of industry professionals and the standards they use such that the services can be provided cross-border without further control or authorization, and the right to work in any EU state. This focuses on the right to move freely across borders, knowing that there is a retention of human rights and workers' rights with a consistency in which such rights are applied. And now I would like to move right in to the presentation for an overview and background. And in that context, I would like to introduce Kevin.
Paul, thank you very much indeed for that introduction. As you said, the UK voted on the 23rd of June 16 to leave the European Union, and you explained what it is we're leaving. But the problem is that was the sole decision back then, to leave the European Union. We didn't actually say what it was that we would join, or what the future form of the relationship with the European Union would be post-Brexit. So there are still many uncertainties, but perhaps I could start by talking about the things that we do know before we get on to things that are still unsure. So the referendum was 23rd of June 16. The Brexit date has been set as 29th of March 19. So that is the date on which the UK will leave the European Union, Brexit Day, as it were. And that's pretty certain. So it's less than a year away. But it's also been agreed that won't be a cliff edge. There will then be a period of something like 2 years, but not quite 2 years, a little less, till the 31st December 2019. I beg your pardon, 31st December 2020. There will be a transitional period to give business a chance to adjust and to allow for transitional arrangements to be made. And during that period, basically, not a lot will change. We'll continue to behave in many ways as if we were still part of the European Union, even though we will have left. So the real date when things will change on the ground will be from the 1st of January 2021 onwards. So that's what's certain at the moment. But in fact, that itself isn't a very long period. The real period to get certainty about the shape of the UK's relationship with the European Union going forwards is much, much shorter. As I say, Brexit Day has been set for 29th of March next year. By October this year, the Brexit withdrawal agreement needs to be put to the European Commission, and it then has to be ratified by all the individual member states' parliaments, to be in time for the UK to leave on an agreed basis by March next year. So that kind of brings the real date when things need to be agreed for to October. But in fact, it's sooner than that, because just the practical reality is that the summer is fast approaching. Many member states' parliaments adjourn for the summer, and so the realistic window is probably over the next few months. Things needs to be pretty clear in order to make it possible for the Brexit withdrawal agreement to be submitted for a formal approval by October. So it's a very short time period to agree the future shape of things, and there's some pretty important things still to be agreed. And obviously this webinar is all about VAT and Customs, so let's talk a little bit about some of those major things that are still to be agreed. Now, at the moment, as you mentioned, Paul, by virtue of being a member of the European Union, UK is part of the European Union Customs Union. And what that gives us is tariff-free access to other European Union member states' markets for goods. And then by virtue of our membership of the European single market, we also get access to effectively the market in services as well. So you might think that when we leave, the priority will be to preserve as many of those valuable freedoms as possible. But in fact, the current UK government position is to leave both the single market, which is wider than just goods, it covers services as well, and the European Union Customs Union. and not to join any other customs union with the EU. You might ask why that would be the government position. Well, there's a lot of politics involved. So, first of all, a big part of the Brexit vote was to regain national sovereignty, and if we remain part of any European Union institution, then you essentially have to surrender some sovereignty to a supranational court, European Court of Justice, and its decisions trump those of our own national Supreme Court. So politically, that's pretty unacceptable. Also, with a lot of European Union privileges, go contributions to the budget, which is another big part of Brexit, that we would no longer have to make contributions to European Union for membership. And then one of the fundamental freedoms that you mentioned, Paul, free movement of people. Well, immigration was a big part of the Brexit debate as well. So any solution that requires us to continue to allow free movement of people from the European Union into the UK without any immigration controls is also politically very difficult. The reason that customs union has been rejected is that because, again, a big part of Brexit was the argument that outside the European Union, the UK will be free to negotiate its own trade deals with any other country. At the moment, part of the price of being a customs union is the UK and all other EU member states have surrendered that right to negotiate their customs tariffs to the European Union. That negotiates on behalf of all EU member states and sets a common tariff. So we can't remain part of a customs union and also retain or regain the right to negotiate our own trade deals. So that's why the government's stance is to leave both the single market and the customs union. However, the politics are very important here. I mean, the government itself is very divided. There's a kind of right-wing part of the government that is in favour of a so-called hard Brexit, where we leave all these European institutions. There's a more left-wing part of the government that favours a softer Brexit, where they are indeed in favour of remaining part of a customs union. So the government itself is divided, but it is also a weak minority government that is being propped up by, in particular, a minority party, the Democratic and Unionist Party, which is the controlling party in Northern Ireland. They are vigorously in favour of the Union with the United Kingdom, extremely set against anything that would suggest more alignment with the Republic of Ireland and any kind of less alignment with the rest of the United Kingdom. So any deal along those lines is going to be resisted by the DUP, and without their support, the existing government could actually fall. If the government were to fall and were to be replaced by the opposition Labour Party, they take a very different view. They are in favour of a customs union, and indeed, we'll talk about this later, in favour of membership of the European Economic Area, and indeed, there are parts of the government's soft Brexit wing who are in favour of membership of the European Economic Area as well. So, considering how close we are to the point where some very firm decisions need to be made, it's quite astonishing just how much is still up for debate. Now, regarding the option the government's currently considering when it comes to customs, as I say, they've ruled out membership of any customs union for the reasons that I mentioned. What they propose instead are a couple of bespoke deals with the European Union. There's the so-called customs partnership. I won't get into too much detail because my colleague Nick will talk about these in more detail in a moment. But under the customs partnership, the UK accepts that there is a tariff border between the UK and the rest of the European Union after we leave, but we'd act as collecting agent on behalf of the European Union and collect customs duties on their behalf. The other option is, again, we accept there's a tariff war between the UK and the rest of Europe, but we go down a so-called maximum facilitation or max fact model, where we use smart technology trusted trader type schemes to absolutely minimise the friction at the border, to reduce as low as possible the practical impact of that tariff boundary. The problem is neither of those models is precedented. I don't think it's precedented between the European Union and any other state. It's probably not precedented anywhere else in the world. So even those two favoured options by the government are not necessarily going to be practically possible in time. But anyway, rather than me talk further, perhaps we'll hand over to my colleague Nick to go into a little bit more detail about those two options for customers going forward.
Great, yes. Thanks, Kevin. The first one was that Kevin mentioned is it's a customs partnership, and this just indicates how precarious and difficult the politics are with all this, because they cannot call it the customs partnership because that implies customs union, and there's already one in existence that we're leaving, so it has to be a customs partnership. How this would work was the UK would apply the EU's own tariffs and rules of origin to all third country goods arriving in the UK that are intended for the European Union. So if the UK is that entry point into the European Union, then the UK would have to apply the EU tariffs. So when the goods arrive in the UK en route to France or the Netherlands, for example, UK customs officials would collect the money due on the tariff, and they would pass it in due course over to the European Union. They then add to that by saying that new IT systems could be used to track whether the items eventually ended up in the UK market or crossed into the EU, because obviously the tariffs would change, because following our exit from the customs union, we will be setting our own tariffs in the UK. They may well not be the same as the European Union's tariffs. So one solution to that would be, and you might expect this because they're collecting money obviously from taxpayers, from importers, companies would pay the higher tariff rate, whichever was higher out of the EU and UK, and then if it found that the goods were going to be in the EU and you'd pay the UK rate or vice versa, then they could claim a refund once the goods had reached their final destination. Interestingly or alarmingly, whichever way you look at it, there's no mention of goods moving from the EU to the UK. So that is a bit of a black hole at the moment. Now, the UK Tax Authority, HM Revenue and Customs, has estimated the cost to businesses, mostly importers. The cost would be approximately £4 billion. So that's sort of option one. Now, option two is the one preferred by the if you like, the hard Brexiteers, the ones that really want to have not very much to do with the European Union when we leave it. And this is the maximum facilitation option, or the max FAT. And this recognises that there's a customs border, but it needs to be as frictionless as possible. So it doesn't remove it, it just creates a frictionless customs border. And they're relying on new technology and automation to streamline procedures and remove the need for physical customs checks. So, you can see a situation where perhaps some sort of camera or scanning or something along those lines just determines what goods you have, maybe using the barcode or something, and putting a value on them. So it builds on existing schemes such as the authorized economic operator or trusted traders. So if you were accredited as a trusted trader, you could basically import them using this new technology, and then you can make a declaration after that to confirm that that was in fact what you reported. Now, these will bring unilateral improvements to the UK customs regime, so they think, but also it would require a commitment from the European Union to try and implement equivalent arrangements at its borders if this scheme was going to be a success. It's kind of regarded as a little bit unlikely, but nevertheless, it's still in play. HM Revenue and Customs only today estimated the cost of this particular option to be in the region of £20 billion. That would be basically borne by businesses and importers. So that's a far more expensive option, and it's very IT orientated. So that's where we stand on those two options, and I think it's fair to say that there's a certain amount of scepticism in the EU, and perhaps Paul, if you maybe ask Turnus for his view of these options from a Dutch perspective.
Thank you, Nick. And I agree, it's very important to understand other European Union countries' perspective and views of the various options. And with that, I'd like to hand it over to Turnus for the Dutch and EU perspective of these various options.
All right, thank you very much, Paul. Yeah, from a Dutch perspective, due to the close relationship and trade relationship with the UK, we are of course in favor of a very efficient border and trade between the two countries. But we have to bear in mind that from an EU perspective, and we are part of the EU, it is said, and also said in the resolution of 14th of March 2018, that when you leave the EU, you become a third country and you cannot benefit the same rights as a member state of the European Union or a member of the European Free Trade Association, or EEA. So this is where we stand right now from an EU perspective. And when you read the newspapers and when you look at the opinion from a Dutch side, we believe that the options, as said by Tob and Nick, are more or less wishful thinking and are very, very expensive because a lot of IT systems are not in place right now. So to be honest, we hope that it will be that we get a solution which makes it possible to have the trade as smooth as possible between the two countries, because we have an investigation done in the Netherlands, done by the Ministry of Economic Affairs, and it is said that only due to the Brexit, the cost for import and export will raise up until 400 to 600 billion euros a year. Only the cost for import and export, and we're not even talking about customs and VAT costs. So only these costs, we would like to lower these costs as much as possible. So we are in favor of a kind of arrangement. And the customs union would be, of course, in favor, but it's only customs, and we also have to talk about VAT later on, which is a different topic than customs.
With that, I'd like to turn it back over to Kevin in terms of the EEA option and the difference between the EU and the EEA. Kevin?
Yeah, thank you, Paul. So we were talking before about the government's favoured options, the Customs Partnership and so-called Max-FAC, that both of these are bespoke options with no precedent. But I think I also mentioned that is by no means a unanimous view, either in the government or so not with the opposition. And some people say, well, there are existing models out there that the UK could slot into, so we don't need a bespoke deal. And one obvious one to consider is the European Economic Area. So what this is another free trade bloc. All of the members of the European Union are members of the EEA, but critically there are a few other countries, Norway, Liechtenstein and Iceland, that aren't in the EU, but they are members of the European Economic Area. So some people are saying, well, the UK could leave the European Union, but still participate in the European Economic Area. And the benefits that would be that the EEA is still a pan-European trade bloc. There's free movement of goods, services, capital, people within it. So you get a lot of the benefits of EU membership without actually being in the EU. The the webinar is all about VAT and customs. From that perspective, it's very attractive because although there's a free trade area within the European Economic Area, so the existing non-EU members like Norway can freely export and import goods on a tariff-free basis. Critically, because it's not a customs union, they still get to set their own external tariffs with third countries. And as I explained, and as Nick explained, that's one of the reasons why a customs union is politically very difficult. So it would meet that objection very nicely. The problem is that with the other freedoms come obligations. So if you've got free movement of people, that means the UK would still have to accept unrestricted immigration to the United Kingdom from, well, not just the European Union, but the EEA amendments. That's the whole European Union plus Norway, Liechtenstein, and Iceland as well. So that doesn't meet the political objective of getting control over immigration. So although on the face of it, it's an attractive model, it has difficulties. The other one I referred to before is that because membership of the EEA would require compliance with the rules of the market, then you again have to have a supranational body, a supranational court to arbitrate when there's disputes between members. Now, in the case of the European Union, the court is the European Court of Justice, and anything that involves the European Court of Justice politically is very, very hard to justify, because escaping European Court of Justice jurisdiction was a key part of Brexit. If we were to join the European Economic Area, we wouldn't be subject to European Court of Justice jurisdiction, but there's another court that we talk about, the EFTA court, and that would have jurisdiction. So it's not the ECJ, but it's another supranational court. So that again politically would probably be hard to sell. So although there are quite a number of people, say both in government and in the opposition party, who are in favour of EEA membership, and it would go a long way to solve the customs issue, the other things that come with EEA membership would be difficult. The other body we need to mention, by the way, so it's yet another acronym, I'm afraid, is EFTA, which Tony's also referred to. So that's the European Free Trade Association. So that's an existing trade bloc in Europe, much smaller than the European Union. Norway, Iceland and Liechtenstein are members of EFTA, along with Switzerland. In order to be a member of the European Economic Area, the UK would actually have to join EFTA, because you can only be a member of the EEA if you're either an EU member, which going forward the UK won't be, or an EFTA member. So again, it's not just a question of what the UK chooses. It would have to be admitted to EFTA by the existing EFTA members, and they might not agree to that. Norway at the moment has a very, very substantial voice in EFTA, and as one of the non-EU members of the EEA, it's an open question whether or not they would welcome the UK joining and becoming another very loud, maybe dominant voice. So it's not just a question of us choosing to join the EEA. We have to be admitted, and the other members and the members of EFTA have to agree to that. So it's by no means a simple solution.
Thank you so much, Kevin. I think that what's clear is that politics has a lot of influence and play in terms of the determination. So now what I would like to do is, in terms of putting on our crystal ball, is to see what the likely outcome is in terms of a prediction. So there I'd like to hand it over to the three panelists, Kevin, Nick, and Tunis.
Okay, thank you again, Paul. So my colleagues will give their views in a moment. My perspective on this is that the impact of the Irish border issue, which we haven't really focused on that much, is huge here and may end up being, the decisive factor. I mean, put simply, at the moment, because both Ireland and the UK are members of the European Union, there is no tariff border between the UK and Ireland. Both fellow European Union members, goods pass over the border completely frictionlessly, and indeed, if you go to the border, there's no obvious sign that there is a political border there either. And that was a position that was arrived at after a lot of hard work and the so-called Good Friday Agreement that ended all of the troubles that had plagued the island of Ireland for the previous 30 years or more. So the current situation was hard won, and the government of the Republic of Ireland, the government of the United Kingdom, and indeed the European Union are all committed to keeping that open border post-Brexit. So obviously that's excellent. But if you try and reconcile that with the fact that post-Brexit there will be a land border between the European Union, represented by the Republic of Ireland, and then Northern Ireland, part of the United Kingdom, it's very, very hard to reconcile those two, because if you have customs duties, you need checks at the border, you need some kind of infrastructure, or you need very smart technology at the border. And then you have regulatory checks as well to make sure that things that are being imported into the UK over the Irish border from the rest of the European Union meet EU regulatory requirements, never mind the customs side of things. So it's just very, very hard to see how you can have an open border and yet, a customs border that is completely open. And any solution that you think of is riven with difficulties. One solution that Brussels has proposed, for example, is that there would be a customs union between Northern Ireland and the Republic of Ireland, and then you would have a customs border between Northern Ireland and the rest of the United Kingdom. Well, that would solve the border problem, but it is completely unacceptable to the UK government and also to the Democratic and Unionist Party in Northern Ireland, who are keeping the current UK government in power, because, as I mentioned before, anything that aligns Northern Ireland more closely with the Republic and in any way distances it from the rest of the UK is political anathema. So I think that ultimately that is going to become such a huge issue that the government will be forced to enter into a customs union between the whole of the UK and the European Union as the only way to square that circle, despite their stated view that they're against it. So that's my personal view of the way this will work out. Nick,
Okay.
Yeah, thanks, Kevin. This is a personal view as well. I think there's, in the government at the moment in the UK, there's quite a large swathe of members of Parliament who are absolutely committed to making sure that Britain leaves the European Union, and no ifs, no buts to leave. And my view is that this is a once in a lifetime vote, probably more than once in a lifetime vote. This is the only chance that they will have to make sure this happens, and they'd be prepared to bring down the government if it's not going their way. So my prediction is that the government will fall, there'll be a general election, there'll be a new government, and that government will implement, for the reasons mostly that Kevin said, will implement a customs union. And that's my view. We'll be out of the single market, but we will be in a customs union.
Okay. Well, I also believe that that from a EU and perspective, it will be the best solution to be a part of the customs union, not being part of the single market anymore. So it will be something like a Norwegian solution, being part of the EEA, or that will probably be the best solution for and working in close cooperation with the UK, which is also what the EU and the Dutch government wants. So.
Thank you very much for that, the whole group. And at this point in time, we'd like to then talk about the UK-Netherlands trade figures. and I'd like to hand it over to Tunis again.
All right, thank you very much, Paul. Just to give you some figures, some ideas about what volumes we're talking about. From a Netherlands perspective, the export to the United Kingdom was in 2017 about 40 billion euros, and we imported from the UK about 24 billion euros on goods. And to put this in perspective, I also looked at the trade figures between the UK and the EU. It's a UK source for goods and services. It is said that the export from the UK into the European Union is about 313 billion euros, and the UK is importing from the EU about 395 billion euros. So there are quite some volumes. And also when you look at the trade volumes between the Netherlands and the UK, so about 14% of the export from the EU to the UK is coming from the Netherlands. So you can imagine that for us it's a very, very important trading partner. The countries are close together. When the UK is leaving, this will be the outside border between the European Union and the rest of the world will also be in the Netherlands border. So it's quite important to have this trade excuse me for that, the trade volumes as smooth as possible between the UK and the Netherlands. So these are about the figures for now, for 2017. Shall we do it again, Andrew, or what do you think?
I thought that was fine. I know you stumbled at the end. If you want to just give that last section again, that'd be fine.
But well, if you think it's okay, then it's okay. No,
okay.
Mind.
Good. Yeah, if you're comfortable with it, then I am.
All right. Okay, that's good.
Thank you. Thank you very much, Tunis. So then we move on to the practical and financial consequences of no single market VAT. So we'd like to look at the UK export to Netherlands. And Nick, if you could handle that, we'd appreciate it.
Thanks very much, Paul. It's probably just worth thinking, first of all, about the single market, which was basically dealt with B2B goods. What were previously importations became acquisitions. And what that meant was no VAT was payable at import. So you didn't physically have to pay any VAT at all when you were importing, for example, from the Netherlands into the UK. What you would do is you would put it on your VAT, your statutory VAT return as money owing to the government, but you could also claim it back. So there's net nil cash flow. The duty with the customs union, there's no duty payable between EU member states. So what happens if there's no deal? Well, for a start, I think we probably should say what won't change. For example, if you're a US investor in UK property, there'll be no change. If you're a US company providing goods for the UK market, there'll be no change. But what will change is if you're using the UK as a springboard for the rest of the European Union. So there's post-Brexit goods coming in into the UK, for example, will be subject to import VAT. Now, Tunis mentioned the trade figures between the Netherlands and the UK. So if the UK imports 40 billion euros of imports, it would have to fund at 20%, 8 billion euros, except it'll be in sterling in the UK, of VAT, and it'll physically have to pay that. So there's a cash flow cost now to moving goods from the UK when it's outside the European Union to other EU countries. So looking at the position of an export from the UK to the Netherlands, we'll use a practical example. At the moment, the UK has to prove, an exporter has to prove that the goods have moved out of the UK. So you have to still have that proof, and you'll still need it post-Brexit. But from the UK's perspective, what that will mean that the problems will come really when the goods arrive in the Netherlands. So the goods are moving out of the UK. That's okay. There's no VAT on those because it counts as an export. So not too bad exporting to the Netherlands from the UK, but what happens when, from the Netherlands end, when the goods are imported from the UK?
Well, we are on the other side in that case. So from a Dutch perspective, like Nick said, nowadays it's an inter-EU supply from the UK to the Netherlands, which has been followed by inter-EU acquisition in the Netherlands by the Dutch customer. So it's only a matter of administration. But when in the post-Brexit situation, we will get a real import. So the UK will become a third country from a VAT perspective. I'm not talking about customs union, we're talking about VAT on value-added tax. This implies that the Dutch customer will then have to pay the import VAT at the border. So you have to pre-finance 21% on the import volumes from the UK into the Netherlands. There are some facilities for companies seated in the Netherlands. So you can shift the VAT to the local VAT filing. So you don't have to pre-finance, but it only counts for companies seated in the Netherlands. So when you're outside the Netherlands, also for US companies coming into Europe, you have to pre-finance the import VAT, or you have to appoint a tax representative. And in that case, you can get some special schemes, special facilities, but then you have to put bank guarantees and so on and so on. So you have extra cost. So we shift from a inter-EU supply and acquisition to export and import between the UK and the Netherlands. And this also counts for other EU member states, the other 26 EU member states beside the Netherlands.
Okay, thanks, Turnus. Now we'll look at the UK importing from the Netherlands, and this is where there are dramatic changes. There will be. For a start, if there's no customs union, there'll be tariffs to pay, and secondly, if we're not in the single market, then we'll be funding the VAT. So there's actual financial cash flow and financial costs if we're outside the customs union and the single market. Even more scary, if you like, is the administration, because unless we have something at the border that will keep things moving quickly, then we're going to have real problems, because there's some scare stories going around that even just adding another 1 minute to each lorry coming through will create tailbacks. You know, and then it depends what sort of goods are coming in. They may be perishable, it'll add time to it. So UK importing from the Netherlands or any other part of the European Union is going to be more difficult and more expensive, that's for certain. So what does it look like, Turnus, from Netherlands exporting to the UK? It's quite bad at our end. What's it like at your end?
It's also bad at our end, because we're afraid of the customs regulations, of course. And nowadays, when you export the goods, we're very afraid, of course, that for all kind of Dutch meat or tulips, flowers, whatever, going to the UK, we have to wait at the border, which is not good for trade. But when you look at, from a technical point of view, from a VAT point of view, it will be still zero rated when you export to the UK, but it's not an intra-EU supply anymore. It will become an export, also at a zero rate, but there are different formalities you have to fulfill at the Dutch side from an administration point of view. And of course, all kind of IT systems should be adjusted, because nowadays it's all based upon the EU VAT system with VAT identification numbers between the UK and the Netherlands. And all IT system, bookkeeping systems are based on these IT systems and on this VAT system. this must all be changed. So it's a lot of work that must be done when the UK is leaving the EU from a VAT perspective.
Great, thank you, Turnus. We now look at to discuss the UK as the European Union point of entry to circulation. And with that, again, we'd like to hand it over to Nick.
Thank you, Paul. This is where the trading activities may well change, and businesses, including US businesses, but any third country that has goods and wants to circulate them in the European Union. Once the UK is out of the European Union, it won't be the optimum place to bring in goods to the European Union for the first time. This is because, for the reasons we've discussed, there's no customs union and there's no single market. So the UK, as Turner said, will still be a third country as far as the European Union is concerned. So all you will have done is brought your goods into the UK. Now that's fine if they're designated for the UK market. Nothing's changed. But if you're bringing the goods into the UK as a springboard for then moving them on into France and the Netherlands and throughout the European Union, then the UK is definitely not going to be your best option as far as the circulation, the VAT and the duties are concerned. There may be other attractions to the UK, but the movement of the goods, the easy movement of the goods throughout the European Union will not be one of them. Almost certainly you'd be better off going to another EU country, because then the goods are in the European Union and they're freely circulated within the European Union. And I know that some countries, including the Netherlands, are making preparations for the upswing, if you like, in imported goods.
Yeah, that's true. That's true. Okay.
Thank you, Nick. And then we'd like to move to the Netherlands preparation. And again, with that, we'd like to hand it over to Turnus.
Yeah, like Nick said, we're already preparing, but we're also looking at clients, facing clients who are asking where should I have my warehouse, and of course the Netherlands is a good opportunity, a good possibility to have your warehousing and as a new gate to Europe. What we're also doing right now is, and the Dutch Ministry of Finance is doing, they started recruiting 1,000 extra customs agents. Please note that at the moment we have 5,000 customs agents. So due to Brexit, they're growing with about 20%. Because whatever the outcome will be, the Netherlands want to be prepared for a smooth transactions and be an alternative for third countries to coming into the European Union, whether you're coming from the UK or from another country outside of the EU. This should be a good facility to come into the Netherlands and doing your customs over here, and then distribute your goods from outside the Netherlands into to the other EU member states like Germany, France, Belgium, or wherever you want to go. So we are preparing for a post-Brexit situation, and to have this trade as effective as possible. So we are prepared for that.
Understood. Thank you, Turnus. I think before we wrap it up, if we may, because Kevin, you've discussed, I know this is a webinar on VAT and customs, but I guess in terms of income tax consequences, maybe if you could just talk about it briefly, because you had mentioned some very excellent points in terms of what U.S. companies will be looking at possibly from tax considerations regarding both withholding tax directives and also double tax agreements.
Yeah, certainly, Paul. I mean, I think, as you say, we've rightly focused on VAT and customs duties because that is clearly the major impact of Brexit. So obviously, if you're shipping goods into or out of the UK or the European Union, there's that very real impact. But as you say, like any decision like this, there were some, perhaps unforeseen or less obvious consequences. And as you say, one of those is in the area of withholding taxes. So at the moment, one of the benefits of European Union membership that the UK gets is that there are a couple of tax directives. So there's the so-called parent subsidiary directive and the interest and royalties directive. And basically, they guarantee that when subsidiaries of say an intermediate UK holding company that maybe is owned by the US, so when that UK intermediate holding company receives payments of dividends or interest or royalties from other European subsidiaries, those are completely exempt from withholding tax by virtue of EU membership. Now, post-Brexit, in principle, the benefit of those directives falls away unless the UK does some kind of bilateral deal, special deal with the European Union. That means they effectively continue to apply. There is a precedent for that in Switzerland, which we talked about earlier, not a member of the European Union, not a member of the European Economic Area even, but it's on a bilateral deal where it effectively gets the benefits of those directives still. So we might do that deal post-Brexit, but if not, you'll then be falling back on the UK's network of double tax treaties with the EU member states. And whilst the UK has a tax treaty with every single EU member state, and in some cases it gives complete exemption, in other cases you may get some residual withholding taxes. So that could increase the tax cost. And then the other point that you referred to, this one is much more esoteric, and I'm sure no one thought about this when Brexit was voted for. But the US treaty with the UK and the US's treaty with other European countries basically has a limitation of benefits article, and at the moment it says even if you're not entitled to treaty benefits as a so-called qualified person, you may still be entitled to benefits if you're a so-called equivalent beneficiary. But equivalent beneficiary is defined in terms of being a member of either the European Union or the European Economic Area. So the UK is leaving the European Union, that won't apply. We've talked about the fact we may possibly join the European Economic Area, but if we don't, the UK would no longer count as an equivalent beneficiary in the US's treaties. So in some cases, payments out of the US to a UK parent company in that direction may be subject to withholding, where at the moment they're not. And I'm sure there are other unforeseen consequences that will only become apparent, as things unfold.
Great. Thank you very much Kevin for that, because I found that enlightening, and I think, as you mentioned, you can see now that there are many factors that just were not in any way envisioned that will have impact, some of even that we can't think of right now, but that as this moves on, it's going to be something that we all have to deal with from a tax and also a VAT customs perspective. So I'd like to wrap it up now, unless anyone of my panelists has any type of other parting comments, words of wisdom. I must again thank the panelists. I really appreciate your input, and I must admit that I did learn something as well, just listening in terms of all the various decisions that have to be made, the uncertainty. So again, I thank everyone, and again, hopefully that this was beneficial to the audience. And again, thank you to everybody. Goodbye now.